Hello, Tsapiso. Surprise, surprise. Oh, we thought you were not coming. Um, okay. We're just waiting for Tsapiso to just settle in. She just got in now. Uh, we thought we thought she was not gonna make it to go to class. So yeah. All right. I hope everyone is fine, and I know we are getting closer and closer to the exams. Yeah, we are already there. All right, so we got a message from Naledi. Morning, Arthur. I don't think I'll make it on time. We'll connect online. Okay, no, it's fine. Naledi will connect online, and then Jabulida is also not gonna make it today. She's taking, huh? Or that, yeah, that's not a car. It's someone. Yeah, she's taking a child to the doctor. Yes, yeah, and then so we're just going to get started. Today we are looking at cost of capital, and we're just going to be looking at exercises that we have from the textbook, and then those exercises that you gave us, and we'll also be utilizing the notes that Tsepiso sent on the group. And then, so if there are any questions, you can just post them. For Madre, you can post them on the group. And then for the guys that are here, you can always ask. Um, and then we'll be able to look into that. All right. So we're looking at cost of capital. Cost of capital. Now, if you remember, normally when we do questions on like capital budgeting, you find that amongst the information that we will be given, there's this information about a certain percentage. They normally call it the rate of return. Sometimes they call it discount rate. Sometimes they call it weighted average cost of capital. That percentage is what we're basically dealing with now. How do you how do you calculate it? How do you come about it? Yeah, so sometimes you'd find questions on that where you are asked to calculate the 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 cost of capital. We call it the cost of capital. We call it the cost of capital, and it's measured in percentage. It's measured in percentage. So today we'll be looking at that, right? So what I want you to know is that when we're looking at capital, remember capital comes in three forms. Capital comes in three forms. We have the cost of debt, right? We have the cost of debt. Um, so debt is part of our capital. Remember, it's part of the ways in which we can capitalize a company. Ne? So now when we get money from debt, then that comes at a cost. So we have cost of debt, and it's normally given a sign KD, right? KD, which is cost of debt. KD is cost of debt. Sometimes they call it they will put it as RD, small r and D. So don't be confused when you see them interchanging. So sometimes it's RD, sometimes it's KD, but mostly they normally put it as KD. All right. So if you see it as RD, it's one and the same thing. All right. And then so that's the first one. And then we've got the cost of preference shares, cost of preference shares. So remember, we can also capitalize the company using preference shares, right? So when we get the preference shares, we also need to get the cost of preference shares, right? And then the last one is the cost of common equity, the cost of common equity. Now this one, cost of common equity and the cost of debt, these are the ones that are mostly popular. You are likely to, if ever it has to come in the exam, you are likely to deal with these two: cost of debt and cost of common equity. So cost of common equity, it can be referred to as RE, right? Or it can be KE, right? So the two are the same: cost of equity, RE, or KE. The common one is KE, right? Cost of equity, cost of equity, cost of equity. So that one is very popular, and we are going to actually look at it. Some of if you look at the what was it, there's a chapter we're focusing on, still valuation of stocks, right, and valuation of bonds. We somehow touched on that. Remember, there's a time when we were saying sometimes you'll be asked to calculate the cost of equity, especially when you're looking at valuation of equity, right? So we touched a little bit on that. We're just going to go through it again and all of that. So some of the stuff I'll write on the board. We'll just take a snapshot and then we'll send it on the group so that others are able to see. All right, so let's look at the exercises from the textbook that were sent to us. So I'm just going to dive into a question, right? I'm just going to dive into a question, and then from there we'll see what goes on. There's a question 5 on chapter 12. Question 5 on chapter 12. Question 5 on chapter 12. And yeah, I think it's page 445 from the textbook. Question 5, page 445. All right, you also have your calculators with you, ne? Yeah, because another thing, you'd find that there are certain questions that would require you to basically use your financial calculator, right? I'll tell you which questions are those, and there are those that you basically don't need a calculator. You use the common formula and then you get your answer. But with this one, this particular question, you would need a calculator, all right? Because it's that one where we use it to calculate IY, which is the interest rate, right? Because of the way the question is structured. But I'll let you know. So the stock of Alpha Tool sells for $10.25 per share. Its current dividend rate D0. So normally when they say current dividend rate, right, that's D0. That's the dividend, initial dividend. Yes. So when you say D0, we're looking at the current dividend. The current dividend, D0. So its current dividend, D0, is 1 rand per share. Analysts and investors expect Alpha to increase its dividends at 10% for each of the next 2 years. So from year one and year 2, the dividend is going to be increasing by what? By 10%, right? 10% each year. So this annual dividend growth rate is expected to decline to 8% for years 3 and 4. Right? So for year 3 and year 4, we'll be looking at a growth rate of 8%. And then it's expected to settle down to 4% per year forever. Right? It's expected to settle down to 4% per year forever. Right? Calculate the cost of internal equity for Alpha Tool. Calculate the cost of internal equity for Alpha Tool. So now if you look at this kind of a question, it's talking about a dividend that is growing at different growth rates, right, for different years, right? So because of the difference in the growth rates, right? We really cannot put the common formula of what we normally have. I'll put it on the board, right? If it was just a single Yes, I'm going to write a formula if it was not given in different dividends and growth rates and all of that. Right? Because the questions normally differ. We'll look at this formula later, but for now, I just wanted us to focus on that. All right? Right. So I've just put a formula on the board. If somebody can just take a snapshot of that. What is it? It's divided by P? Yeah, that's dividend. Dividend for the current dividend plus the growth, because the growth will be given in the question. Right? Dividend, current dividend plus the growth over P0. Remember, P0 is the price, the par value, right? The par value plus growth. So normally, sometimes you find that a question comes and it's so basic like that. It will just tell you that the stock is selling the current the par value is so much, like maybe it will say $10 $25, and then the current dividend is so much, and the growth for the next year is going to be so much. So when you are asked to calculate the what is it, the cost of that equity, you will just punch in the figures as they are given. So it will be so easy like that. But if you look at this question now, it has got different years, right? And the growth in the dividend is also different. So now we cannot use that formula. Why? Because it's mixed up. There are many years to consider. There are many growth rates to also consider. So this question is a unique one, and maybe the reason why they gave it to us, maybe it's coming in the exam. All right. So let's look at how we are going to answer this one. They are saying calculate the cost of internal equity for alpha tool. So obviously we need the amounts for the dividends in their respective years, right? So remember another thing, just like I said last time, when you are looking at information on dividends, right? When they say D0, don't consider D0, right? Always start from D1. Remember, D1 is for year 1, D2 is for year 2, D3 is for year 3, D4 is for year 4. And then in this case, remember the final year was year 4, but we are told of a growth rate that was going to go on and on and on, and we normally call it the terminal value, remember? Right, so that's why I put D5 there. So we need the dividend amount for each and every year based on the growth rates that we are given. So let's start by calculating the amounts based on the growth rates. So maybe I'm just going to quickly get back to the question, which says the stock of Alpha Tool sells for $10.25 per share, right? And its current dividend rate, which is D0, is R1. So that we are working with the dividend rate, which is currently at $1 per share. So we want to now check for year 1, because they're saying analysts and investors expect Alpha to increase its dividend at 10%. So for year 1 and year 2, we are going to be increasing that at 10%. So I want you to check my calculation for D1 and D2. D1, I took $1, right? That's represented by that 1 there, right? Let me put my highlighter on. So on D1, I've put a 1 here, which is $1, which is, remember, the current dividend is standing at $1 per share. So this $1 has to be increased by what? By 10%. So that's why I'm saying $1 multiplied by 1 plus 0.10. Yes, it's always 1 plus 0.10 because we are adding the 10%. And when we add the 10%, we get 1.10, right? We get 1.10. So this is the dividend amount for year 1. This is the dividend amount for year 1. This is the dividend that is expected at the end of year 1. All right, D2, based on what we discussed last time, I remember there's a time when we were dealing with a similar question like this, but we're dealing with valuation of common stock. So people prefer that, we would prefer taking this value, 110, and we just multiply, or we just add the next 10%, all right, growth. So that's what I've just done here, just to make life easy for everyone. So now, remember, for D2, we are taking the latest, which is $1.10, multiplied by another 10% growth. So we are adding 10% growth based on what we had last time, and then we'll end up having $1.21. A question.
Is there any reason why at D2 in brackets that 10 is not in decimal form?
Can you come again?
For D2,
Yes.
in brackets, the 10 is not in decimal form. Is there?
Oh yeah, you are right. It's actually a mistake there. Thanks for highlighting that. It's actually supposed to be 1 plus 0.0 point. Thanks for that. It's 0.10. 0.10. Thanks for that. Do you see that as well, Tsapiso? Yes, it's supposed to be 1 plus 0.10. I'll make a correction there when I send the slides. Thanks for that. So that it will give us 1.21 when you punch it in your calculator. When you punch in your calculator, it's supposed to give you 1.21. All right, and then for D3, remember for D3, they said for year 3 and year 4, the growth rate is now going to be 8%. Right, so I'll just take the latest amount that I have, 1.21, and I add 8%, and 8% is represented here by 0.08. 0.08. 0.08. And then I'll get 1.31. I'll get 1.31. 1.31. All right, are we covered? For year 4, another 8% growth. For year 4, it's another 8% growth, so it's 1.31. 1.31 multiplied by 1 plus 0.08, another 0.08, and we get 1.41. Right, and then we are told that, let's go back quickly. The last part, they are saying, and then to settle down to 4% per year forever, and then to settle down to 4% per year forever, right? So calculate the common, before we go that, let's just see how we're going to put that into effect. So we go to D5, remember what we do with the terminal value, 1.41, which is the latest, multiplied by the growth of 0.04, and we got 1.47, right? So we have the value at the end of year 4 is equals to 1.47. This is how then we calculate that terminal value. 1.47 divided by the rate minus the growth. This is supposed to be 0.04. This is R minus 0.04. If you still remember the formula for the terminal value, remember it's the value that we have here of 1.47 divided by the rate, right, minus the growth. So the rate, remember, we don't know the rate yet. That's why we're just replacing it with R. And that's what we basically need to find out. That's what we basically need to find out. All right. 0.04, remember it's the growth from at the end of year 4 until forever, right? Until forever. So the formula, remember that formula we dealt with before when we want to calculate the terminal value. It will be 1.47 divided by the rate minus 0.04. In this case, 0.04 is the growth. All right. I've just put R there because we do not have the rate of return, and that's what we're basically calculating. That's what we are calculating. All right. So with this information, having calculated this information, we know the current price of the stock, which is PV of all future cash flows, after having added all these, right? After having evaluated all this and we are calculating the PVs, we know that the value is $10.25 because of what the question has told us. Remember, when we're looking at the valuation of stock previously, we would normally want to calculate this value. Remember, by putting the discount rates, and then after that we add everything together and we'll get our P0 or our present value at $10.25. So this time around, it's already given to us. So we are working with $10.25. So we are saying basically $10.25 is equals to the addition of all these cash flows multiplied by the discount factors. Right. I know it looks a little bit different from what we were dealing with, but it's basically the same, right? So remember what we would normally do if you were given a rate of return, like a percentage, you would just go to your tables, right? In this case, you'll go to table what? Table 2, right? You'll just pick a percentage and say, okay, this is the percentage, and then I'm just going to pick the year, which is in this case year 1, and then you just multiply this by the factor. So this time around, you are not given the percentage. This time around, they are saying look for it on your own. You see how tricky that is? Yeah. So I don't want you to get so much confused about what's happening here. This is basically what we would normally do. It's just that this time around, we are not given the rate of return, and we need to find it on our own. All right, so let's try punch this in our calculator. That's why I was saying a question like this, you definitely need your calculator, because otherwise you would have to solve this R mathematically. And in the exam, you don't have all that time. So this is what we'll do. In your calculator, make sure that you clear your memory. Let's try this out. All right, so your PV in your calculator, your PV is going to be 1025.
So what do we do? We say 1025 PV.
Yes. 1025 PV, right? And then you have got different amounts Uh, no, wait a minute. Wait a minute. Before we put PV, can you just clear your memory again? Can you clear your memory? Can I have someone's calculator just to see because the first amount we got, you already cleared your memory, ne? Okay, 1.10. 1.21. Okay, I'm just trying it out on my calculator so that when you do it, you also get the correct answer. Oh, 1.47. $10.25 is PV, and then 1.10. Can you clear how do you clear your memory? Second function. Okay, thanks. Come again? No, for this one, because we are looking for R, we're not going to be able to use the table, right? It's like what we need to do is we need to put the values in our laptop, in our calculator, and then whatever values that we would have put of those different years, remember for the dividend, 1 rand 10, 1 rand 21, 1 rand 31, we now need to say compute IY, right? Then it gives you the answer straight away. Then it gives you the answer straight away. Had you done it separately? I see you were referring. I'm trying to figure out how you put it in this kind of a calculator, because the one that I'm used to is the sharp calculator. Mm. But it's fine. You know what I'm thinking, eh? I think I'll figure this out later on in terms of how you punch it in your calculator, because I just need to research.
Okay.
Yeah, on the part of in, the thing is, mathematically it needs to be solved like that, right? If you actually check what we have there, we have 1 rand 1 Rand 10 for year one, right? So we are basically saying 1 Rand 10 multiplied by the PV, present value interest factor for year one. So remember, in the present value interest factor, we are not given the percentage. That's why I have retained my R as it is. Right?
Arthur,
Yes.
are we dividing or are we timesing?
We are dividing by.
Yes. So okay, I'll explain to you what's happening. So for year one, we are saying 1 Rand
Yes.
10 over
Yes.
1 plus
1 plus R.
Yes, that's how I
Right.
broke it down as well.
Yes. So this is the normal formula, and it is the same when you're saying, let me just put it in equal sign here. It's 1 Rand 10. This is how we normally used to do it. We'll say 1 Rand multiplied by the present value interest factor at a certain percentage, right, comma, and then you put the year. So this is the same as that.
Yes.
It's just that now you're not given the percentage. And the year here you're already given, so we are looking at year one. So the issue is we need to find that percentage. So that percentage here is represented by this R. So this formula and this formula is one and the same thing. So you only do this when you're going to be multiplying it, but when you are putting it in terms of the rate, like in terms of punching it in your calculator straight, you need to say 1.10 divided by 1 plus R. Yeah, it's just what do they call it, mathematical laws that are being applied.
Yeah.
But here, this and this is basically one and the same thing.
Yeah.
So I wanted to explain so that you understand what I've done here. What I've done is to say 10 Rand, $10.25, right, is equals to 1.10 divided by that. We get a value, and we are going to add it with another value, but this is for year two, right? And we need to remember that when we put it in our formula, we'll say 1 plus R to the power 2, right? And we say plus 1.31 and then to the power 3, and then we add it like that. So all these things that we are adding, they need to give us 1025. So it's like we need to prove then and find out what then is our R, because R is the missing figure, right? So you normally basically just punch it in your calculator and you then just get your answer. I don't want you to be solving it mathematically because it's going to take 3 hours, your whole 3 hours in the exam. And I want you to avoid using the mathematical method. I want you to just punch it in your calculator and you get an answer straight. Right? So what I'm saying is I just need to try and figure out how you put the figures in your calculator so that you get an answer like that.
Naledi is calling.
Naledi? Okay.
Sorry, Arthur.
Yes.
In the exam,
Yes.
we must put.
Utswile nangona something mo boarding.
You know when you say 10.25.
Arthur?
Yes.
They are worried that Naledi was saying they can't hear you, and I said to her you were doing something on the board. That's why you went off.
Oh yeah, Naledi, can you hear me now? If you can hear me, just indicate with the WhatsApp message. All right. So you were asking a question, Lebu.
Yeah, so in the exam, as much, so we're not going to do anything mathematically, but this, this long part that you've got there, that 10.25 equal to da da da.
Yes.
We must write that out in the exam.
In the exam,
Work
yes,
it out.
yes.
Well, we don't work it out.
You don't work it out. You just need to show. Yeah. You just need to show. Don't try to punch it in your calculator as if you are solving it mathematically. It's going to take you forever. But you just need to show. I think this is the most important part. You are basically saying $10.25 because you're already given that amount should equal to all those amounts having been added together. Remember what we were doing on the valuation of stock. When we wanted to come up with they would say what is the value of the stock in year 0, and then we would add all the present values after we've discounted them and all of that. So we are basically doing the same thing here, right? But what we now need to do is to prove then what is R, right? So I just need to quickly, I'm thinking of the time and all that. We might take a lot of time me trying to figure out, but let me do it towards the end of the at the end of the class, because the calculator that I was actually using was a sharp calculator, and it gave me 15.98%. So we just need to make sure that we highlight that this is what we are doing in order to get that answer. But you don't necessarily need to be doing it one by one in the exam. All right. So I'll deal with that towards the end of the class, and then I'll just give you a snapshot on what to punch, and then we'll take it from there. So for a question like this, it's a little bit tricky because you need to show all these calculations. But imagine if your question was given like you're just given the present value, right? It's already worked out for you, and you are given the dividend, the current dividend, and you are given the growth. You are just going to punch the formula like the one that we are given on the board. So you would punch in your, like in this case, your D0, remember your dividend in year 0 is $1. Yeah. So you just say, maybe we should actually take it as a practice, right? Just to show you what I'm saying here. So let's assume our P0, right, is going to be $10.25. You can maybe write it somewhere. Your P0 is $10.25. And then they'll tell you that this share is giving a current dividend of $1. So your D0 is $1, ne? And then they will tell you that the dividend is expected to grow at 10%, at a 10% growth. So now they will say, calculate the cost of that stock. Calculate the cost of that cost. So what you'll do in that information, because this is a basic or a simple way to calculate it, you just take that formula that we have on the board, KE, you can write it, KE is equals to D0, just like we highlighted on the board. For Naledi and Madre, you can also apply the formula that was sent on the group by Lebu, right? You can apply the formula that was sent by Lebu. KE is equals to D0 multiplied by 1 plus the growth. You are already given the growth, isn't it? The growth is 10%. The growth is 10%. So it will be D0 multiplied by 1 plus G over P0. Our P0 is already given, eh? Our P0 is already given. Yes. Our P0 is already given, is the $10.25. And then on the side, you say plus the growth, and always put the growth in decimal, ne? Always put the growth in decimal. So I just want you to let me know what answer you got. If you can calculate that, sorry for your calculator. Yes, we're using that formula. We're using the formula that was put on the group by Lebu. The given information is that your P0 is $10.25, and your growth is 10%, and your D0 is D0 is $1. So okay, Madre has just sent me her answer. We'll wait for the others just to find out. Yes. We're just waiting for the others to.
KE is the unit of measure is also percentage, right? At the
Yes, it's actually a percentage. That one is a definite percentage. It's the same as rate of return. Yeah. All right. Lebu seems to be done. Tsepiso is still working. No, it's fine.
Okay, let's hear the others.
Come again. All right. What did you get, Lebu?
21%.
Come again.
21%.
21%. Okay, Lebu got 21%. Tsepiso also got 21%. All right. So.
Are you sure?
Uh,
Who's wrong? Is everybody?
If I'm wrong, all both right.
No, if it follow the. Okay, let's hear the
okay.
others.
I'm just going to take the headphones off for those that might be wondering about my voice gone. So I'm just going to calculate it on the board, and then we'll take a snapshot and then send it on the group. All right. So we're
Can't they
just going
just
to
give it to
apply
us
this
like this
formula.
in the exam?
Okay.
Huh?
Can't they just give it to us like this in the exam?
And something like this is going to come out of the exam.
Yeah. All right. So we have KE is equals to, if it comes like this, I think it will be a bonus for you guys.
Oh,
Yeah, but if it comes like that, you'd find that it's we here we only just need to figure out how you punch it in your calculator.
Okay.
Otherwise, it's not so much of a big deal.
Okay.
The only tricky part of this is that there's a lot of information.
Information, it
missing.
confuses.
Right, so that's the boring part. All right, so our D0 was $1, right? So we say $1 multiplied by one plus what was our growth?
0.10.
0.10. So
Yeah.
0.10
yes.
over our
10.
P0 is 10,
10.25.
25, and we say after that we
That's
add
0.10.
Gross.
0.10.
Yeah.
All right, so we need to first solve this, and then
Yeah.
after we get this, we then add that.
Yes.
Right? So here it will give me 1 point what?
One.
Like this.
It's
Yes.
1.10 over 10,
25.
25 plus
0.10.
0.10.
Yeah.
So if we punch in our calculator 1.10 divided by 10.25,
0.11.
Yeah.
0.11. 0.11 plus 0.10. So it's also good that you do it in stages.
Yes.
I know there are calculators that you can program and they can give you a straightforward answer, but sometimes it's risky, especially if you're going to be using your basic calculators, because it will give you a weird answer if you just punch it straight. Like some people I know, they might want to do it like this. One, they put brackets and then they, so sometimes it might end up giving you a weird answer. So this will give us 0.21,
21.
right, which is
21%.
21%. All right, so our answer is 21%. Lebu, if you don't mind, can you just take, can you please take a snapshot again? Sorry to bother. All right, so our answer is 0.21 or 21%. Right, Lebu is just going to take a snapshot in terms of how we calculated that, and then um, all right, so 0.21. So that's how you're basically supposed to calculate it. That's how you're basically supposed to calculate it. You just apply the formula, right? You just apply the formula with the information that is given to you, right? But now when it's given as like the way it's given in question 5, you then need to do it separately year by year by year, and then at the end of at the end you need to prove that 10.25 is equals to the summation of all those values, and then you then just quickly solve for your R, and then after that you are good to go. So I want you to know, I want you to don't be worried that if it comes like that, how am I going to do it? Just follow those steps, right? Follow the steps, calculate your because one thing you need to know is that you're also going to gain what do they call those? Formula marks. So the moment you calculate D1 and you get a value there of 1.10, that's a mark already. All right. So, and then you calculated this, you calculate this, you calculate that, you calculate that, you calculate that. You are basically getting marks because it really shows you understand how you are going to get the answer. But this is the last part that you always need to remember. This is your P0 or your present value, right? Which is actually the addition of all these things, and then at the end of the day you just quickly solve for your R, and then you get your answer. Come again? Definitely, I'll help you do that. It's not a big deal. I just need to figure it out, and then I'll let you know. I'll even give you. I think I'll even send you another similar question like this, so that you can also practice, and then we'll see what answers everybody has. I just need to look for maybe a similar question from like that in the textbook, and then everybody gives it a try, and then we're good to go.
I'm actually thinking it's a good thing that we might get everything right, but the answer because of the calculator. But at least if we do the whole steps.
Definitely, definitely, yeah.
That's what the professor was saying. You don't have to get 15.98%. You can get 12, you can get 0, it's okay.
You must just see
As
how
long
you
as
got
you
there.
showed your
the
understanding of
the
what
formula,
was
yeah,
given.
how you came about your answer. Yeah, it's always important. So now if you look at what we're doing here, we are focusing more on the 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 cost of equity, because when it comes to cost of capital, the one that is mostly tricky is this one, on the cost of equity. This is where you need to know your story, how to go about it. But when it comes to the cost of debt, right? The cost of debt is always like given in the question. Right? I'll show you a question like that, which is talking about the cost of debt and all of that. It's always given in the question, and so you don't need to really struggle, much about it and all that. So, but with this one, this is the basic formula, the one that was sent by Lebo on the group, right? Where you are given just like your present value, the dividend, and then the growth. So you're just supposed to work at it like that. Even when it's what is it, the cost of preference shares, you also calculate it like that. The formula is basically the same, right? The formula is basically the same. And when it comes to the cost of debt, they will always tell you, just like when you go to a bank, ne? And you're applying for a loan, right? You apply for a loan, but now in terms of the percentage that you need to settle for, it's basically a discussion that you have between you and the banker, ne? So it's something that you just settle for, and then you know that I got a loan, but this is how much I'm going to be paying for it and all of that. So when it comes to the cost of debt in the exam, it's always given. They'll always tell you that the cost of debt is so much percent. All right. Any questions so far on what we have done on question 5? On question 5. Yeah, you are you are scared, ne? Tsepiso is scared. There's no need, ne? There's no need to be scared.
Even when we were doing this in class,
Yes.
the professor was asking, "Are you okay?" And I
Yeah.
said to him,
Yeah.
"Did I get a 0 for this question?"
You'll capitalize on capital budgeting.
There's so many ways of getting a question like this,
Yeah.
different ways, and I'll get confused. It's okay as long as I get the others right.
Yeah. No, it's just that you find that most of the questions in financial management is just that the cost of capital is always given to you. So normally, I think I also used to have the same thing. Say you are normally used to working with a question, and they always tell you that the cost of capital is like this. So it's something that is already given to you, and you don't have to really, work it out yourself. But now, when it comes to a situation where you have to work it out yourself, you're thinking, oh, okay, how do I go about it? So it's just a matter of sometimes giving it time, right? You just practice, and then you see the more you practice, the more it's going to be better for you. All right, can we move on to the next one? Next question, question 6. Question 6 on the same chapter. Okay, there's a message. Um, um, Madre says you are not alone, Tepiso. So it's nice when you know that you're not alone. Ne? Eh? So even in the exam, just know that you are not alone. There is many of us, but don't worry, guys. Don't worry. My advice for now is it's a common feeling when you look at it for the first time. Everybody is always having this, yo, how am I going to deal with this? But I tell you, the more I give you questions, even if you struggle with those first few questions, you'll find that you're actually improving, right? You'll find yourself improving, and it's going to get better, I tell you. Right, so I promise I'm going to even send more questions on that maybe during the week. I thought maybe the strategy I'm going to use this time is to maybe look at one question at a time, and maybe avoid giving you a bunch of questions. Because otherwise, people will never attempt those questions. So maybe the easy approach is to look at a question one by one. Right? We send a question and we say, okay, can everybody do this question? Let's see what answers we got, and then we share, and we see how it goes. All right. Um, the next question, is it Hartley Hotel Corporation? Okay. So um, for this one, we are looking at, I'm going to explain why you can get a question like this. So now, remember especially when it comes to cost of equity, just like I said, you are likely to get a question that has to do with the cost of equity, cost of equity, cost of equity. So when you are calculating cost of equity, what we have done here, it's one way to do that, right? Based on the information that you are given. This is one way in which you can calculate the cost of equity. But another way to calculate the cost of equity is to use the CAPM model. Remember last time we looked at it, the one that has got beta and all of that. That's another way in which you can actually calculate the cost of equity, right? So we call it the CAPM model, capital asset pricing model, capital asset pricing model. Now, don't be for this one. There is not even a reason for you to be scared, right? This is the easiest. In fact, if you can get a question like this one, question 6, in the exam, you have every reason to even shout in the exam. I know the invigilator is going to call you into order, but this is a good question because it's easy. It's like you just take a model and you just place what you are given into that model, and then you just get your answer straightforward, right? It's nothing complicated. So let's just quickly jump into the question. The Hartley Hotel Corporation is planning a major expansion. Hartley is financed 100% with equity, right, and intends to maintain this capital structure after the expansion. So remember, another thing we need to do here is to understand what's happening. This company is financed 100% with equity, so which means it does not have debt, right? It only has equity. And intends to maintain this capital structure after expansion. So Hartley's beta is 0.9, right? So remember the beta is measured in points, like we said last time. So this information is given to you. That's why I'm saying you should actually celebrate, because everything will be given to you. The Hartley's beta is 0.9. The expected market return is 16%, and the risk-free rate is 10%. If the expansion is expected to produce an internal rate of return of 17%, should Hartley make the investment? Now, with this one, I'm going to give you a formula. I think I've already put it on the slide there. Yes, yes. Tsepiso has a question. Yes. From the class. Yes, please. Yes. The CAPM. Oh, yes. Yeah, yeah, yeah. All right. From Tsepiso, remember she attended the scope class. So this is the time you should be, your attention should actually be very high on this one. She says this is very, very important. The lecturer was emphasizing much on this. So just like I said, if you get a question like this, you have every reason to celebrate, right? Because it's easy, right? It's just you're looking for, okay, like let's go into the formula. Maybe it will make it easy. So cost of equity. So what are we calculating? Cost of equity, just like KE, right? Remember they were calculating KE. So this is also KE. Cost of equity is equals to, listen, this is what you're looking for in the question. You're looking for your risk-free rate. And it's always given in any question. So you're looking for your risk-free rate. You're looking for your beta. You are looking for your market return, and you have your risk-free rate. So now, if you check this risk-free rate here, right? This one, the first one, is the same as this one, right? So now, what I want to explain here is that in this bracket, we have market return minus risk-free rate. Together, they give us what we call the risk premium. And the reason why I'm highlighting that is that sometimes in a question, it won't necessarily give you the market return, right? But it will tell you that the risk premium is this. Then you know this portion is covered. You just take this and place it here. You see what's happening? So I always like this question because to me, this is free marks, right? This is really free marks. So now let's quickly go back into the question. This is what I want you to do. I want you to read the question, and I want you to note on your free space. I want you to identify the risk-free rate. So you'd write risk-free rate is equals to this percent, beta is equals to this, market return is equals to this. Yes. All right. So let's go back to I want you to read this. Now, I want everybody to identify the risk-free rate. Just say risk-free rate is 10%. Yes. We write it in decimal. Come again? Yes, put it as a decimal. All right. So your risk-free rate, according to this question, is 0.10 or 10%, right? That's your risk-free rate. The next thing you want to identify is your beta. Identify your beta from the question. 0.9. Right? So you write my beta is 0.9. Can we identify our market return? Yeah. You also write it in percent in decimal. Yeah, write it in decimal. All right, so we are covered. And then after that, you just go apply it in the in the formula. Cost of equity is equals to risk-free rate decimal plus beta, you are given your beta, multiplied by market return minus risk-free rate. So everything, just put it in decimal. Naledi was complaining about her screen. Just let us know if it has improved, Naledi. And also just to check from Madre if your screen is fine. Sometimes you'd find it's the oh yeah. Yeah. It's not too difficult. Yeah, yeah. So my main highlight on this one was just to help you you need to be able to identify those things. And this is a formula that is very easy to apply because come again. Yes, 0.16 minus 0.10. Okay. All right, yeah.
Are you good, my little friend? Let's go, my friend.
Yeah, just we are calculating that and see if you're getting a different answer.
Lebo, when you calculate your 0.9 times the 0.16 minus the 0.10, what do you get?
0.054.
Yeah, so solve the bracket first.
Yeah, I did 0.16 minus 0.10 gives me 0.06.
Yes. And you times that by 0.9.
Oh, it will give me that.
All right, you got it.
Yeah, I have to find it. Oh, yeah. Hey, manje yami iklari 0.060.
All right, and Naledi, if you need assistance, Madre is an expert when it comes to this technical um, stuff. She can help you.
I get 15% flat.
Ah,
I get 15%,
Same
not
here.
15 point.
Same here.
not
Yes.
15.4.
Yeah, I get 0.15.
I got 15% on the dot.
Yes.
Okay, it's fine. I think it should be because of
Decimals.
your decimals. If you put it to 3 decimal places or 4 decimal places, you should get 15 point.
Yeah, it gives me 50% on the dot. I think this is how our HP calculators are
Yes.
Yeah.
set.
Yeah, Konjo, how did you do it last time? How did you increase the decimals? I remember you did it for. Is it you who
No,
did?
it's Jabulile.
No,
Yes.
Jabulu uses sharp.
Yes.
Oh
You
yeah.
use Jabulile.
This
Yeah.
is the one that you use.
Yeah. And somebody did it on this one. Who did it on the HP? Was it Naledi? Yeah, somebody did it on this one, but it's fine. It's acceptable. 15% is acceptable. And then, so now, remember the question is not done. If you check on top, they say if the expansion is expected to produce an internal rate of return of 17%, should hardly make the investment. So who still remembers IRR, right? The qualifying criteria or the acceptance criteria of the IRR. Do you still remember? Who still remembers? What is the acceptance criteria or the qualifying criteria of the IRR? Who still remembers? This is capital budgeting. Yeah, it's a for those that looking at the board or those that are looking at the screen, you already got a hint. All right. So remember with the IRR when we just like we okay, remember the NPV. We said with the NPV, if it's positive, right? If it's a positive NPV, we accept the investment or the project. But with the IRR, remember we need to compare it with the cost of equity. Yes, we need to compare the IRR with the cost of equity. If the IRR is greater, then we go for the investment. If the IRR is greater or bigger than the cost of equity, then we go for the investment. So remember what we were doing last time in capital budgeting, where we say if you're calculating your IRR, remember your cost of capital was already given. So you'll just compare your IRR with the cost of capital. If it's greater, then you accept the project.
So in this case, the IRR is 16%.
Yes, because remember it's standing at 17%.
So you see now, it's an issue of terminology.
Yes.
Market return IRR is the same thing. But in an exam, you panic and not.
Yeah, you definitely. So you just need to know your qualifying criteria of your IRR. If the IRR is greater than the cost of equity that you are given or the rate of return that you are given, then you accept the investment. Any questions? Mm, I hope you also get that. Those are free marks. Those are free marks. I like this because it's simple and it's straightforward. You don't have to be doing, all that stuff that we were doing earlier. All right. Any questions? Any questions? All right. Now, quickly, remember here we are dealing with the CAPM model, right? Now, I don't know, maybe Tsepiso can guide us on this one, but remember sometimes your beta, sometimes you find that you are given an equity beta, and sometimes you are given an asset beta, right? So I just need to cover this part so that at least we are not completely lost. The asset beta versus the equity beta. Remember that part? We actually dealt with it in the assignment. I think it was assignment 2. Sometimes you are given two betas and you don't know which one to use or which one to apply. So what I'm going to do, I'm just going to quickly um, um, get out of this screen so that I want to use the question that we did in the assignment as practice on this one. Right. So I was saying, Lebu, still whilst you're still on CAPM, right? Sometimes you'd find that the beta that you're given, like you'd find in this question, they are just telling us that Hellis beta is 0.9. So we make an assumption that 0.9 is an equity beta. Because another thing you need to always know is that this beta that we are talking about here, it's an equity beta. Remember last time we were playing around to and fro on this part. So you always need to highlight that this is the equity beta, always. Because sometimes you'd find in a question, right, they will give you an equity beta and they will give you an asset beta. So you be stuck in terms of which one do I choose of the two. So you always need to choose the equity beta. And sometimes you'd find that also the question will only give you an asset beta. And it will say, calculate the equity beta that you need to apply here. Right? So I'm going to use the question from the assignment, right, for practice so that we are aware of what's happening here. You'd find that with the practice, it's actually going to make it easy. Can I quickly go out of this so that I can? All right. I think it was question 5. Yes, it's question 5.
Did you do question 5?
Yeah, I was actually, I think the questions that what's the name? Naledi sent me because she sent me a snapshot. I could not find question 18 from those snapshots. So I thought I would look at it first with you guys, and then we'll see if we are going to.
Question 18 on page 450. I gave page 415.
Yeah, we have to do it.
All right. Quickly, I just wanna go to that from current slide so that everybody can be able to see. But it's fine. I'm sure they are still able to see the screen as we have here. So quickly, they are saying here you are required to analyze your company using an equity beta. You see here they are specifying it. You are required to analyze your company using an equity beta for an industry that is comparable to the company. The company is funded half with debt, and the appropriate tax rate is 30%. All right. All right. So the equity beta for the industry is 1.10 based on the risk-free rate of 3% and a market premium of 5%. Now, if you look at this, remember what we need to identify is the risk-free rate, right? So what is your risk-free rate in this 3%, right? Which is 0.03. So that's your risk. Remember on that formula, we need the risk-free rate. What is your beta? And remember that you always need to get out of each and every question is the equity beta, 1.10. Because it's already indicated. If you check, it's saying it's where is it? The equity beta for the industry is 1.10. So this beta is already sorted for us. This is what we want. All right. So we already have our beta. What is our do we have a market return? Yeah, you find that in this question there's no market return. Eh? So don't be trying to look for a market return. Yeah, we already given a market premium, so it's already covered for us. That bracket, remember, towards the end. So
Sorry, it will be the market premium will obviously be your risk-free rate minus.
no, it will be the market return minus the risk-free rate. Yeah, but
In this case, we just use 10
that bracket, yeah,
0.05.
yes. So, but remember, sometimes you are not given the market return, but in this case, you are given the market premium. So it's already sorted for you, right? So I want you to calculate the cost of equity based on this information that we have. What is the cost of equity based on the information that we have? All right, for Naledi and Madre, you can also calculate. I hope you are able to see the screen.
This is from assignment what? 2.
With the information that we have on the board, can we calculate the cost of equity? Whilst you're doing that, Sapiso, can I please have your textbook? Thank you. And if you have your answer, you can just post it on the group. Yeah, let's see if we can.
Yeah, okay, normally, let me go back.
Wait, I get 36.
0.5%. I don't know, let's just hear us.
All right, what do you have?
Which I have 8.50%, but anyway, let's hear the other
What
one.
do you have?
36%.
Okay, that's a huge margin. Okay, let's hear from others on the group what percentage they got on that one. All right, so we're just going to, I'm going to do it on the board, and then we'll see.
Did they post?
Come again?
Did they
No,
post?
they haven't posted anything
Oh,
yet,
okay.
but I'll just do it on the board anyway, and confirm with what you have. All right, so now, even if you got it wrong,
It's
don't
fine.
despair. I just want you to, this is what I want you to do. I want you to look at it, go through your own work and see where you might have missed it. Ne?
Okay.
All right, so our KE is equals to the risk-free rate. The risk-free rate is what?
0.03.
It's zero, isn't it 03, 0.3? It's 30%.
All right, let's go
No,
back again.
risk-free rate is 3%. You took the
Yes.
tax rate. You
Yeah.
use the tax rate.
No, okay. Okay.
All right, so you already saw, ne?
Yes.
You already noticed. Uh, 0.03.
0.03.
All right. I like this because it gives you an opportunity to look at
Attentively.
your
Yes.
work and where you might have missed it.
And I wrote everything
Like
right
remember
because my
then I made the same
formula.
remember I made the same
Yes.
mistake
I already
at
put
one
in
in one of the questions.
Yes.
Okay?
Plus the beta, the equity beta is
1.10. 110.
1.10
Yes.
multiplied by, we
Zero,
said we don't have the market rate, but we are given the market premium of
0.05.
0.05.
Yeah.
So I'm just going to say 0.03 plus, what is this multiplied by that?
It gave me 0.055.
0.05. Yeah.
0.055.
0.055. And I'm just going to add these two,
Yeah.
and then I should get what?
0.085.
0.085,
5.
which is 8.5%.
50%.
Yes.
Bingo.
And that's what I got after changing.
But at least you got it, my friend. Can I see the picture?
Yeah.
All right, so we should be getting 8.5%.
I think the trick for me here is that market premium versus the, you see that more formula where you have your risk-free rate minus whatever, market return minus risk-free rate. I think
Yes.
that's where the confusion will be with me. We just have to be
Yes.
careful. Unaledi has lost connection, sorry.
Naledi has lost connection. Okay, she's back now. All right. All right. So 8.5. You should get 8.5 based on the calculations that we have done. Eh? So just like I said, you just need to. It's more. This one is also more of your attention to detail. We check which percentage because sometimes there's a lot of percentages inside, so you need to pick the right one, right? And then you do the right thing. All right. So we are done with the first one.
Which question, which assignment is this question
It
for?
was assignment 2, question 5. Assignment 2, question 5. All right. So we have already done it there. It's 8.5, right? 8.5. And then let's look at the next one where they are saying Why is it not moving now? Needs to move. Okay, so they are telling us then on 5.2 that later you find that there has been a mistake, right? There has been a mistake. And the equity beta for the industry is actually the asset beta. You see, that's where the issue is now. The equity beta for the industry is actually the asset beta for the industry, right? So based on the a debt to equity ratio of 1.0 and tax rate of 30%, what is the correct equity beta for the industry? And what is the correct equity beta for the industry? Now, I'm going to explain this and I'll repeat. Please ask if you are not going to get it right.
Is this the assignment?
Yes, this is the assignment. This is the assignment.
So basically now we have to calculate what is the equity beta.
Yes. So they actually saying there has been a mistake. What they thought was the equity beta is actually the asset beta. Yes. What was so the 1.10 was actually the asset beta, not the equity beta. So now that you are given the asset beta, which is 1.10, they are now saying, can you calculate the correct equity beta? Right? So now what you are going to do is you're going to use, I hope these guys will, but I'll still explain. But I wanted to come here where we are saying the equity beta is equals to beta levered. Right? I want you to write that on your notes. Equity beta. All right, I was just explaining something on the board. I think equity beta is equals to beta levered, right? And then asset beta is beta unlevered. So once you understand that relationship, it's going to be easy for you. Equity beta is beta levered. And then asset beta is beta unlevered. Asset beta is beta unlevered. Now, there is a method that you use, or there is a formula that you apply, which is what is shown on the board, to convert asset beta into equity beta. So that's the formula that you're going to be using. Remember, we want to convert that asset beta into equity beta. So this is what I want you to do, so that when you go back and make references, this will be easy for you to understand. Where I have put beta levered there, right? So you are also going to write it as the same. You say beta levered, but in bracket you write equity beta, so that you know that it's one and the same thing. So beta levered bracket equity beta is equals to beta unlevered is equals to beta unlevered. Then in bracket you write asset beta, because I want you to familiarize yourself with that, right? As often as you can, familiarize yourself with that, because it has a tendency of playing with of messing up your mind, right? So beta unlevered, which is the asset beta. And then in this case, since we are converting the asset beta into an equity beta, we'll say beta levered is equals to beta unlevered multiplied by 1 plus 1 minus the tax rate multiplied by debt over equity. Multiplied by debt over equity. We normally call the debt over equity, we call it the debt to equity ratio. Yeah, the debt to equity ratio. The debt to equity ratio. So you are converting the asset beta into the equity. Remember, the equity beta that you always need to focus on, or the one that you need, is the equity beta, right? And that's the one that you actually need to put into that formula. So in 5.1, we were covered because there was no mistake yet. But in 5.2, there is a mistake. What they thought was an equity beta is the asset beta. So now we need to convert that asset beta into an equity beta, and that's how you convert it. That formula there, beta levered is equals to beta unlevered multiplied by 1 plus 1 minus tax rate. The tax rate will always be given to you. The debt to equity ratio will also always be given to you. The debt to equity ratio will always be given to you, but sometimes they will tell you that the weight of debt is so much and the weight of equity is so much. So that's why I put it there. You just put debt, the amount, the weight of the debt, you put it on top over the weight of equity, right? So that at the end of the day, the debt to equity ratio has to amount. In this case, it's actually equals to 1, which means it's half-half. You need to also understand this. Yes.
Company is funded by half of the debt.
Yes.
And obviously half of that is the
That's true. So I want you to make a connection because for some people they might be wondering, why are we saying that the debt to equity ratio in the question? It's saying 1. But on the formula, debt over equity, we are saying 0.5, 0.5. So it's the same. It's always going to give you the same answer because 0.5 divided by 0.5, it gives you 1. So we have a debt to equity ratio of 1 in the sense that they are both equal. They have an equal weight in the company. So the company is half funded by debt and also half funded by equity. So we end up having a debt to equity ratio of 1. Yeah. But let's say we had a debt to equity ratio of maybe let's say 2:1. That would be a different case because 2 parts is funded by, let's say, debt, and then 1 part is funded by equity and all of that. So you always need to understand the difference between which is which. But this is my proposal. My proposal is to say, go back to the original question. The question will always tell you that how much is the company funded by debt and how much is the company funded by equity. Yes. They always give you that information. So in this case, I just go and put, I have funded, so I just put 0.5 and then 0.5. And then it makes my life easy. All right. And then we're now going to say, yeah, we're just going to multiply everything because it's like putting everything where it's supposed to be. Unlevered was given as 1.10. Right? So that's what we have there. Multiplied by 1 plus 1 minus 0.3. Remember 0.3 was our tax rate, right? 0.3 is our tax rate multiplied by 0.5, which is our debt, and 0.5, which is our equity. Or because you're already given a debt to equity ratio of 1, you just put it as 1 here. It's one and the same thing. Yeah. All right. So after you've calculated everything, you're supposed to be getting 1.10 multiplied by 1.7, and then you get 1.87. So your new equity beta now is going to be 1.87. All right. So now you got your equity beta. With this information, right? Now your equity beta is 1.87. What is your new cost of equity? The other variables, they remain the same. But what has only changed is your equity beta. So can we try and do separately? Calculate the new cost of equity using the new equity beta of 1.87. We now have a new equity beta of 1.87. All right. Naledi, thanks for highlighting that. Now we are going to tackle it. We are going to, she actually indicated that I remember we struggled with this conversation before. I'm glad you're at it again. All right, so we're going to nip this in the bud this time. 1.87, that's our new equity beta. Can we calculate the new cost of equity? Our risk-free rate is the same. We now have a new equity beta of 1.87, and our risk premium remains at 5%. So let's calculate the new Okay, whilst you're doing that, I'm also trying to figure out question 18 so that when we do it, I'll have the answers.
Then I'm getting 12.4.
I get 12 on the dot.
Why do I get 12.4? I got 0.12. I get, then if you percentage it,
0 point,
12.
yeah, then I don't even use the calculator. I just,
12%.
yeah, you got 0.12.
Yeah.
So I just, and then that's what I got. So, and then I just change it to 12%.
We got 12%.
Naledi and not Naledi, Tsepiso and Lebu got 12%. They got 12%. Let's see, I'm looking at it. It seems as if we have tag teams. Lebu and Tsepiso, Lebu and Tsepiso getting 12%. Let's see Naledi and Madre if you're also going to get the same. So Naledi and Madre, you're also the other tag team, and let's see which one gets the right answer. All right. Um, all right. The other tech team also got the same. All right. So are we fine with this one? We are okay now. It's a matter of practice. So the only thing you need to know, first and foremost, as a rule of thumb, the equity beta is the one to always go for, right? The equity beta is the one that uh, um, the equity beta is the one to go for. All right. I wanted to check with Madre. Um, um, I'm going to show you the one that I have already because she got a different one. I think maybe the issue might be with the calculator, Madre. I think the issue might be with the calculator. Maybe I might need to really check how you are punching it in the calculator, because normally it's always how you do it, how you punch it in the calculator. If you do it in a certain way, it might give you a different answer. So I'll come and check again on you and see how you are punching it in your calculator, but it's not a train smash. Let's quickly see. Are you tired now? Oh, okay. Oh, yeah. Uh, okay. No, that's fine. I think around 12:15, we'll see if you are finishing up. But I think we are left with a few things. Remember, we also quickly need to do the other questions as well. I just needed to make sure that we are covered in terms of. So you got how much? 12%, ne? It's okay. 12% is okay because here we have 12.35. So it's what is it? Yes, it's decimals and all of that. It's a question of decimals.
Remember our calculator, our HP, I think the way it's been set, ama-decimals akhona are set at a lower decimal.
At a lower decimal, yeah.
As opposed to, because sharp, it gives you exactly that.
Yes,
Gives you
exactly.
multiple, I think it's
Yeah,
decimals.
yeah,
Is just one.
yeah. I'm more familiar with the sharp calculator. With the HP, I really need to sit down with that calculator and really go through each and every key, and so that I can easily master it, like you noticed with the first question, right, and all that. So I just need to sit down with it and then figure it out and all of that. All right. So 12.3, if you got 12%, it's still fine, right? So this is how you convert the two. And normally in the exam, you are expected to do that because the one that they require is the equity beta, right? So this is how you go about doing it, right? I know last time there were issues, or how do we convert, and this is basically how you do that. And if you can master especially this part, you'll be good to go.
Are we going to still do, are we going to do another exercise on standard deviation?
On standard deviation,
Risk and return.
what I wanted to do is, because what I'm trying to do here is to make sure that at least we cover all the topics. But what I'll do to cover you on standard deviation, uh, during the week, can I give you a question? Right? I'll give everybody a question. We practice on that all together. Send our answers. We compare. Right? Yeah. I will even notify you on the group that okay, the question has been sent, and let's deal with this, and then we deal with that. And I think it's the best way to go. Would you prefer that? All right. So now, can I quickly go back to uh, yeah, cost of capital?
Is
Okay.
this already loaded on the?
On the online platform. It's already there. It's already there. Okay, quickly going back to the okay, we dealt with question 6. We dealt with question 6, and then um, after question 6, after question 6, when I looked at the one, there is a question in the textbook, the one that Sepiso was talking about, right? Before I move on to the next part, because I don't want to move to something totally different and then we come back to this one. Question 18 from your textbook, or it's on page 450, right? Before we attempt the other question, I think it's on chapter 13 because we are still on chapter.
Are we doing this one?
Yeah, whilst we're still on chapter 12, can we go to page 450? Let's go to page 450 now. I could not be able to pick, Naledi did send them to me, but I struggled to locate it from the snapshots. But now we quickly need to do that, right? And I want us to do it as an exercise, and I'll help you through the exercise on the board, right? So we are looking at question 18, which says
Intermountain Resources is a multi-divisional company. It has 3 divisions with the following betas and proportion of the firm's total assets. So we are given the name of the division, the beta, and the proportion of assets, right? So now, they are saying the risk-free rate is 7%. So remember, we are still on the CAPM model. That's why I said let's quickly do that, because we are still on that. So the risk-free rate is 7%, and the market risk premium, you see, it's already given for us, right? We are not given the market return. So the market risk premium is 8%. A, what is the firm's weighted average beta? What is the firm's weighted average beta? We dealt with this similar question like this last week, right? Where we need to calculate the weighted beta. The weighted beta. If it's possible, if you have your notes close by, can you check a question that wanted us to calculate weighted beta? Whilst I'm going to be putting the formula on the board, but I want you to quickly, let's attempt question A together. Even if we are not yet used to do this, let's just do it for the sake of practice, because it's going to help us. There's a question that wanted us to multiply the weight. Yes, I can already see you're looking at it. That's the one.
The long use question say this is my problem.
Yes.
Is it question?
The long formula.
No, it's this one. Let's see. No, it's no.
Yo, the weighted rate.
Is
Wait.
it question 6 on 302? I don't know.
Yeah. Do you have the original question on there?
Yeah, let's see. Oh, the actual question. I don't have the actual question.
What?
I just said question 6.
It's on page
On
302.
page 302.
Do you have?
I wrote it down. I said, let me just go to page 302.
Yeah, I just wrote the page.
Yes. The same thing that you did there is what you're going to do here. You multiply the beta by the weight it has.
And the rate.
Yes. Remember here, that's why I'm.
Xerox and forward what?
See question 6, ne?
Yeah, page
Number
302.
C.
Yeah. What does A want us to do? Can you read it for us? Let's go back to question 18.
It says, what is the firm's weighted average beta?
What is the
Firm's weighted average beta.
weighted average beta? Right? So we have got 3 divisions, né? We have got 3 divisions and they've got different weights. So this is what we do. We will calculate the weight of the first division one is called what?
Natural gas pipelines.
Natural gas. So I'm going to call it NGP. Right? Natural gas pipeline. Eh?
Yes.
So its weight multiplied by beta for NGP plus the other one is called what?
Oil and gas production.
Oil and gas production. I'm just going to oil and gas production, OGP, multiplied by the beta for OGP, plus, what is the weight for the other one? No, not the weight, the name.
Oil and gas exploration.
Oil and gas exploration, so it's oil GE. OGE. Alright, multiplied by the beta for OGE. Alright, so now I've given you the formula. This is what you always need to do, because sometimes when you're looking at a certain company, you find that we've got different divisions. So if we have different divisions like this one, you will be asked to calculate the weighted average beta for the whole company, given the 3 divisions, right? So now, let me see if I can just also take a snapshot of that so that I can I can post it on the group.
We call it NGS, no?
All right, so can we calculate the weighted average based on calculate the weighted average based on the formula that I've just given you? I'm posting the formula there on the group. Yeah, calculate the weight of each.
The proportion of the asset is the weight.
Yes, yes. Proportion is the weight.
Or if it was something invested.
Come again?
If it was something invested in the asset, it would have been a weight.
Yes. So it's like when you add everything, it's supposed to give you 100%. So if you check here, 50% is that, 30, 20. So that's the proportion. So now when you calculate the weighted average, you take the weight, and the weight is the proportion.
And the weighted are decimal.
Come again?
Yeah, I was about to say, is this the one where we have to,
One
we,
over
when we
two.
use a decimal, one we use as a percentage?
Yes. Yes. Yeah. Just wanna confirm something. Um, Naledi, the question is on page 450, page 450 in your textbook, question 18. Question 18.
Then what's your first, what is the weight?
Can I quickly correct something, ne? Can I quickly correct something? Yes, I think you're under. I wanted to correct what you just said, ne? Remember, what we are calculating is the beta, right? And I didn't want to mix it up. When you put the weight, put it in decimal, because remember, what you want at the end of the day is beta, and beta, we only need, it's always represented as points. We don't want it as a percentage, right? So because we don't want the beta as a percentage, it means everything has to be calculated in decimals. But it was going to be different if we were calculating the expected rate of return. That's when we do the percentage versus the decimal. So here, because we want the beta and we want it presented in a decimal form, put everything in decimal. So the 50% for the first one, what natural gas something, put it as 0.5. Yeah. Let everything be in decimal. Madre and Naledi, when you calculate that, as you put the figures into your formula, make sure that everything is in decimal. Make sure that everything is in decimal. Uh,
All right. Uh, you also got 1.01. Okay, this side we got 1.01. Let's see if others are getting the same answers from the other side, then the other tech team. All right. So,
You know what I'm finding with these things? Sometimes it's not like it's not difficult. You just need a starting point. And
yes,
once you know, like, and then it's easy.
it's easy. Yes,
That's
yes,
why it needs practice.
that's true.
Nina
Okay. The other tech team also got 1 point. Is it 1 point? You got what? 1.01. Yes, 1.01. All right. So we all got the. Um, let me just see. Madre's just sent in the. Yeah, perfect, perfect, Madre. That's a good one. All right. Naledi also got 1.01. So I'm glad everybody is on the same page, right? So we are done with part A. Let's move on to part B. Let's move on to part B on question, the very same question, question 18. Question B says, what required equity rate of return should the firm use for average risk projects in its natural gas pipeline division? So we are focusing on natural gas pipeline, which is the first one,
Yeah.
which is the first one. So now, remember when we were what we were calculating here is the weighted average beta, right? And if you were, maybe if the question was going to say what is the required equity rate of return for the whole company, we were going to be using that beta that we just calculated now, the weighted beta, everything put together. But now this question is specific. It's actually picking out one of the divisions within the company, which is the first one, which is the first division. So it's saying what is the equity required, what is the equity rate of return, what is the required equity rate of return that the firm should use for the average risk projects in its natural gas pipeline. So here, everything is the same. Your risk-free rate, right, is the same. Remember, you are calculating the cost of equity now. So you need to go back to the CAPM model where we look at the risk-free rate plus the beta multiplied by the risk premium.
Oh, that other one is the one we did last week was expected rate of return.
Yes, it was the expected rate of return. So this one, we're calculating the cost of equity using the CAPM model. So your risk-free rate remains the same. I want you to look at question 18. You are already given your risk-free rate, and then you are given your risk premium. The beta that you are using here is the specific beta for that division. Do you see what's happening? Use the specific beta for that division. Don't use the weighted for the pipeline, yes. So don't use the combined beta because you are not calculating the required equity return for the whole company. You're only calculating for a specific division. So it means you're only going to use the beta for that specific division. Right? But everything else remains the same. Risk-free rate, beta, and all of that. So let's calculate and see what answer we get on B. What answer we are going to get on B. I'll be back just now.
So, risk-free rate. Oh, guys, I think I wanna come out with this paper. I'm telling you, I'm scared every day.
When
Mm.
it's like the thing with like it's like I feel like when we just had an author in the exam just to say
Shawena,
step one.
Shawena,
Everything
like it
is
will be
step one.
kickstarting. Okay, market premium is
And this question, it looks in a way it looks complicated, but because
But
we've had practice
but
with these other things, it's like you can get it. But doesn't get it if others
check. And like this question is going to like that guy was very clear. Ari, the exercises that we did in class, make no mistake, you must know them. Just know them. Tell me when you're done.
I am
13%.
good. I'll be by 13.
All right, we got, what did we get this side?
13%.
That,
This tech team is getting a distinction.
yeah, this tech team.
Pressure is mounting.
The tech team this side is getting a distinction. They've just, okay, let's hear from the others. If you are also getting the same percentage, 13%, let's see if you are getting the same 13%. You can just send your 13%. It's actually good when you practice it.
That's what we were saying with Lab.
Yeah,
We were saying that with Lab.
yeah. It makes it easy. It makes it easy. All right, so the other guys will send their maybe their answers later. But if you look at B, I think it's similar. B is similar.
B,
Is it BC?
no, C.
C.
What required? Oh yeah, it's the same
Is
thing,
same, but
for the
looking at a
last one.
different division. Or
At the last division, oil and gas exploration.
oh yeah, this one I like it. I like it because it's combining two divisions, ne?
What?
Or am I?
No, just one.
Is it?
Yeah, it's the same, but for a different portfolio, but the last one. I think they're
Oh.
trying to confuse us. What required rate of return
Mhm.
should the firm use for average risk projects in its oil and gas exploration division?
Which
Is
is
the
the
last
last
one.
Yeah, the last division.
The last
Oh,
division.
okay.
Okay, what is Naledi saying? It says, where is the question?
Okay, Naledi says I'm lost. We'll try.
Oh, let me
No.
send her the question. She asked me to send the question. Ish.
Oh, okay. Okay. No, it's fine. Sepiso is going to send you the question. All right. Madre got 12.6.
Yeah, it's still fine.
It's still okay because that can actually be converted to 13%. So it's very much acceptable.
You see this group?
Yeah.
You're going to be proud of
I
yourself.
told you guys are going to come out with a distinction in this exam. You're going to come out with a distinction. So 12.6 is perfect. And I was going through how you calculated it. Everything is perfect. Everything is perfect. Let's attempt, I don't want to explain much. Let's attempt C. Yeah, let's attempt C. Let's attempt C.
I'm from the shops.
Hmm.
9 hours there, waiting for them to open.
Is it? I can imagine.
Like not coming to class is a problem.
Yeah. All right, let's attempt C.
Yes. What do you have? 19%. Let's see if others got the same 19% for C.
Remember the difference here, we were just changing the beta.
Yes.
Then the rest of the information is the same. Ne?
Yes.
So if we get this type of questions,
Those are free marks. All right. So uh, we are okay with this one now. I just wanted to confirm we've got one last question that we need to do. One last question, and then we can call it a day. So this is CAPM, right? This is as hard as it can get with CAPM model. Just like I said, if you get a question on CAPM, you should actually be glad because those are supposed to be free marks. Those are supposed to be free marks.
remember when we see the word CA, like when we see
Yeah, the word CAPM, the acronym, and you think it's complicated, only to find it's not that. All right, on the second one, Naledi got 19. Perfect. Perfect, perfect, perfect. Madre also got 19. Yeah, you guys are coming out with distinctions. I tell you. You, you guys are coming out with distinctions, I tell you. All right. All right. So this one, this is what I want us to do. There's a few things I'm going to explain here on a question like this. This is actually, it's actually not the one from the exercises that we did. This was a past exam paper question. I don't know why I wrote, chapter 13 there. I was actually supposed to say it's October, November 2018. October, November 2018 question. I think it was the last question. October, November 2018. Yeah, if you actually go to online, the first video that I did and the PowerPoint slide that I did, you'll actually find this answer there because it was there, just that we did not deal with the question. Yes, but it's a good thing that we're looking at it again here. Right, but I want to quickly explain something because these questions, they are normally confusing, right? And sometimes you'd find they normally come with, what do they call it? They normally like they normally correct it later, and I've seen it happening on most of the times. So I want us to look at this question first. Remember, it's October, November 2018, so you don't have to worry much because the question is already here on the board. So it tells us that Sibanye Gold Mine Company has estimated the cost of debt and equity capital with bankruptcy and agency costs for various proportions of debt in its capital structure. So this part of the question was not there. Where it's saying it's in the exam paper, it was missing totally. It was supposed to be there. You see how confusing it can be. So it's a good thing because sometimes you find they bring it as an errata to say, okay, make sure that you know that the marginal tax rate is 40%. So now, I don't want you to get there. I know they will always fix it in the exam and all of that. So I just want to give you quick highlights on such a question. One thing you always need to figure out in terms of this question is the marginal tax rate. It has to be there. It has to be there if in this column, because the question normally comes in this format. And then they tell you that this is the pre-tax cost of debt. Ne? Pre-tax. When something is pre-tax, it means it has not been taxed. Ne? So when it comes as pre-tax, then definitely you need the marginal tax rate information. So if you do not have that, I know in the exam, the invigilator will normally say, okay, let's quickly go to question, the last question, the marginal tax rate is this, so that you know in the exam you are covered. But if you get to that question and the invigilator has not said anything, you can simply raise your hand and say, okay, I'm having pre-tax cost of debt information here, but I do not have the marginal tax rate percent, and they will be quick to actually give it to you. But now, what I've also seen them doing is that sometimes they will give it to you as after tax cost of debt. After tax cost of, if it is after tax cost of debt, then you don't need the marginal tax rate. Then you do not need the marginal tax rate. If it is after tax cost of debt, because the tax has already been calculated for you. The tax has already been calculated for you. Another thing you always need to know is that the only portion of your capital that is affected by tax is the debt. The only portion of your capital that is affected by tax is debt. So whenever you get a percentage which says this is the cost of by the only portion of capital affected by tax is debt. Is debt. So that's why here your percentages, whatever percentages that you need to get under debt, you always need to check your cost of debt. Is it a pre-tax or is it an after-tax cost?
Will it be, will I have to know by working out, or will it be given in the?
Yeah, I'll let you know where to work that out. I'll show you. But what you need to know for now is the fact that your cost of debt is affected by tax rate, and I'll show you how it's affected. So remember, this is chapter 13, right? Remember previously we were looking at chapter 12, which was, we were just basically calculating the cost of equity, cost of debt, cost of preference shares, and all that. And mostly the questions are going to come under cost of equity. Now, that was chapter 12. Chapter 13 is dealing mostly with the way, what we call weighted average cost of capital. Crucial. Yeah, it's very crucial. Ne? So you need to be careful about that. Now, remember, okay, even if we are not able to complete here and all that, we still have next week to go through it. But previously, chapter 12, again, we were looking at cost of capital, looking at the separate elements. Ne? But here we are looking at what we call weighted average cost of capital, where we take all these components of capital, and then we combine them all together so that we can actually get what we call weighted average cost of capital. We call it WACC. So sometimes you find if we are dealing with if we are doing capital budgeting, sometimes you find that your rate of return is represented as a WACC.
The what?
As WACC, weighted average cost of capital. All right. So you normally get a question like this. This is a typical question. Wait. Yes.
I'm telling you, Professor said it's very, very important.
So it's likely to come in the exam as well. So you have got the debt ratio, and then there is the pre-tax cost of debt. Yes. It's a piece of. It's part of the question. Yeah, it's part of the question. So I want you to guide you through the structure of that table, so that when you, because if you look at it, we've got certain parts of that table that are missing. Like if you check here on A, B, all these A, B, C, you need to calculate them. You need to be able to calculate them. But now, for you to be able to calculate those, I'm going to give you, first and foremost, the formula for calculating WACC, weighted average cost of capital. So the formula is the one that you have on top. WACC, or weighted average cost of capital, is equals to the weight of debt, multiplied by the cost of debt, multiplied by the cost of debt,
remember KD is the cost of debt, ne? Multiplied by the cost of debt multiplied by 1 minus T, and T, remember, it's your tax rate. So why are we saying multiplied by 1 minus T? Because we want to take the tax portion out. That's why I said the cost of debt is always affected by the tax portion. So that KD that we have here, this KD, is the pre-tax cost of debt, right? I want you to understand something. It means this cost of debt has not been touched as yet. It's still raw. It's not affected. So if it is not affected by tax, it means you need to bring the tax component into it, right? So you always need to say 1 minus the tax rate so that you can remove the tax portion out of that KD. So that's what you always need to do. But let's say this KD, the tax component has already been applied, because sometimes they'll say this cost of debt is an after tax cost. So you no longer need to apply this 1 minus T because tax has already been taken care of.
When it says after tax,
Yeah, it's what we need. Okay, let me just highlight this whole part here. When you multiply these two, this will give us an after-tax cost of debt. You see where I'm highlighting? These two, KD multiplied by 1 minus T, altogether, when you multiply these two, they will give us an after-tax cost of debt. And that's what you want. That's what you need. So KD multiplied by 1 minus T, it gives us an after-tax cost of debt. After-tax cost of debt. Why? Because tax, the cost of debt is always affected by the tax. All right. So, question. Are you covered? Is debt, yes. So we are done with debt here. You remember this is the weight part, weight portion, multiplied by the pre-tax cost of debt multiplied by the tax portion, and then plus weight of equity. This is the weight of equity multiplied by the cost of equity. Remember, you no longer need to apply the tax because equity is not affected by tax. That's why we are not applying the tax portion here. So weight multiplied by KD multiplied by 1 minus T plus weight of equity multiplied by the cost of equity. Now, if you go back to your table, right, first and foremost, that formula of work is the one that's going to guide us. It is the one that is going to guide us. Now, the first one, remember, we're looking at this company is funded by both debt and equity, right? So we have got various proportions. It's like the company is saying, it's a trial and error. It's saying, in this case, let's just look at the first row. I will explain the first row for you. The debt ratio, which is the proportion of debt within this company, is 0.00. What does it mean? What does it say? There's no debt, which means the company is funded 100% by equity, right? So this portion, this part of calculating A should be very simple for us. If there's no debt, do we even bother calculating the cost of debt? So A is equals to 0 or 0.000000, right? So A is equals to 0. B is equals to what? Okay, you are in the right direction, but I want you to look at it here. Remember, we are focusing on the cost of equity. So the cost of equity, we want to calculate it as B, but we are told that our weighted average cost of capital is 12%. So I want you to, I'll go to this portion here, right?
So this whole portion, because the weight is equals to 0, this is equals to 0, we don't even worry about this portion because it's 0 multiplied by 0 multiplied by any number is goes to 0. So we don't really need to worry about this. And then we come to this part. What is the weight of our equity? It's 100%. 100%. Fully funded by equity. So this weight here is going to be 100%. Right? And how do you present 100% in decimal? What's 100% in decimal? You say 100 divided by 100. It's 1. Interesting, isn't it? Yes. Yes. 100 divided by 100. Yes. So 100 divided by 100, if we are to present that in decimal, it will give us 1. So we say 1 multiplied by cost of equity, and it's going to give us, here we are already told that the weighted average cost of capital is 12%. So 1 multiplied by something is equals to 12%. Obviously, it will tell us then that B is equals to 12%. All right, I'll write it on the board. Or let me see if I'll write it on the board. Our work is equals to, we said we're not going to worry about the first part, né? We're only going to focus on this part. All right, so remember we're working with the formula, and we are told already that this is 12%. Right? This is already 12%, and I know that the weight is 1. Right? And I'm looking for KE. So I'm going to make KE the subject of my formula. And I'm just going to put this one this side. Right? So it will be 12% divided by, because this is multiplication, divided by 1 is equals to KE. Which, yeah, so my KE is equals to 12%.
So we have to redo this thing because it's going to come out in the exam.
Yeah.
You know why? Because the same question in the book, he said to us, this you must do, and you must do it individually. I even wrote, do it individually.
Oh, yeah.
So you must do it, it's going to come out in the exam. But when I
All right, so, all right, so, let me just take a snapshot of that. I've just sent an answer to that. So now our B, I actually made a mistake. Do you see there? I put my B as 0, right? I think I was feeling sleepy. Yesterday I slept around 2. Yeah, so, okay, quickly, we're still going to do it anyway. So our B is supposed to be 12%. Right? Our B is supposed to be 12. That 0 is actually a mistake. We have just calculated that. So B is our KE here, and it's supposed to be 12%. So 12%, 12%. All right, let's go to the next part. Right? We need to calculate C. We need to be able to calculate C, and I'm just going to explain it on the here. Look at what I'm doing. So I'm just copying this whole formula and putting it here. So 0.15, which is my the weight of debt.
0.15, which is the weight or the proportion of debt, multiplied by cost of debt, which I don't know, is given as C, multiplied by 1 minus 0.401, 0.40, remember, is the takes rate, plus my weight for equity. Now, you need to be careful because the proportion of debt is 0.15. Automatically, it means the proportion of equity is 0.85. 100 minus that. Yes. Thank you for that. So, or another way to put it, because remember this is 15%. You would say 100 minus 15%, or you could simply say 1 minus 15, 0.15. Come again. Okay. So you need to know that everything has to add up to 100% between the debt and the equity. That's why in the table, there's no, here there's debt ratio, right? But there's no proportion of equity because they know that once they give you this, you should know about the other one. All right, so 0.15, so it means here we need to have 0.85 because you're saying 1 minus 0.15 or 100% minus 15%. So this is 85%. So 0.85, you always need to write it in bracket. This is where you need to now, the other one is in bracket, the other one is percentage. So 0.85 multiplied by 13%, we are told that the cost of equity is 13%. Yes, it's given from the table. I'll show you, there's the 13%, right? And it's supposed to give you a work of 16.8, right? So if you go here, I've already put, why am I putting 11.68? Yeah, my numbers are a bit messed up. Yeah, but this is supposed to be 11. I think the correct one is this one, 11.68. 11.68. I'm looking at the others. It's supposed to be in that range. 11.6. So that is our work. Now, with all this information, I'm now supposed to calculate C. So what I'm going to do, I'm going to make C the subject of my formula. So here, to be honest, you need to know your mathematics. Yeah, you need to know your mathematics. It's like when you are given a formula, you make one of the variables there the subject of that formula. So if you are to make C the subject of the whole formula here, what you're going to do is you're going to first calculate this, right? I want you to calculate this and see what you're going to get. 0.85 multiplied by 13%. What do you get? 11.05, which is 11.05%. Ne? I want you to calculate this part as well. So here we have C, but you have this and that, which you can also do the calculation. So you are basically saying 0.15 multiplied by, we know that when we say 1 minus 0.40, we'll get 0.60. Ne? So we are saying now 0.60 multiplied by 0.15. What do we get? 0.09. So we call that 0.09 C. We just say 0.09 C. All right, 0.09 C. We have 0.09 C here, ne? And here we have 11.05. So now I'm going to make C the subject of the formula. I'm going to make C the subject of the formula. This is what I will do. I will take this 11.68, which is what I've put here, 11.68%, ne? Minus, because here remember it's a plus, we are going to make it jump the border. So if this is going to jump the border that side, it means it's going to have a negative sign. So it will be 11.68% minus 11.05%, everything over 0.09. Remember the 0.09 that we got on C. And if you divide the answers that you get here, you should be getting 7%. Let's try that out and see if we get the same percentage. Right. For those that are tired, I know we are going towards the end of the class, so there's that effect. So don't worry, we'll still go through this again. Yes. Yes. In fact, yeah. In fact, I'm thinking next week we'll start with that one, because at least then your minds will still be fresh. Right? So you get 7%. Are we all getting 7%? Yeah, it's a table that you need to know your mathematics, especially when it's like that, where you need to calculate that portion of, like C, in this case, it's the cost of debt, and you need to present it like that. You should be getting 7%. And then, quickly, whilst others are still trying to get the same answer, can we attempt the third one, D, and then I think I can end with that one, right? D is straightforward because D actually wants us to calculate. I know it's normally easier when you have to calculate the work, right? So you're asked then to calculate the weighted average cost of capital. You see, D is quite simple. Yeah, I'm just going to leave it like this, right? Or this one. Okay. So you just punch it in you first solve the one on top, 11.68 minus 11.05. And then once you get the answer, you divide that by 0.09. You should be getting 7%. Yes. As our weighted average cost of capital. Now lady says she sees flames. uh, the lady, they are saying you are not alone. It's flames all over. The house is burning, but but it's fine. I know it's not really because we are not getting it. I know it's because of we have taken too much. We have taken too. I just want us to attempt the last one, and then we'll close for the day. The last one being D. Let's do the last one, D, and then we officially close because the house is on fire. Okay. For those that are able to do it, just apply the formula, calculate the weighted average cost of capital, and then we close it. We'll start with that question next week. We'll start with that question next week. Yeah. Let's see who is able to give us the right answer on this one. you're going to apply it. You're going to apply it because this is the pre-tax cost of debt. So remember the original formula that we looked at, right? I want you to apply that original formula into that because here you are not going to be doing the funny things of making C the subject of the formula and all that. You're basically applying the formula as it is. Yes. So it's easier. I think this is the base. This is the how can I put it? It's once you understand what you're doing. That's why I want us to do it. Because once you understand what you're doing here, it becomes simple for you when you're calculating these other funny variables within the same formula. Yeah, and yeah, apply the formula. The formula is work is equals to come again. Yeah, put it in decimal. Put it in decimal. I'm guiding you. It's work is equals to debt portion multiplied by cost of debt. You just put it as it is. 8 multiplied by 1 minus 0.40 plus, okay, plus what is the weight of our equity? That's the part I'm mostly interested in. Yes. If our portion of debt is 0.3, now you know. Yeah. If our portion of debt, I know once you get that part, it's going to give you a head start. It's going to give you a head start. Yes. That's the weight for equity. So the weight for equity is 0.70 multiplied by 14.5. You see, the potential is so much there. Yes. Naledi, you see, the house is not as much on fire as we thought. So just put that into the formula and see what you can come up with. Let's see what we will get as the weighted average cost of capital. All right. What did you get? 11.59. Let's see if Madre also got the same. So there's a lot of issues coming together. 11.59. Yeah, Madre, you got the correct answer. Yes. So I think we need to end here. We are hungry. We are no longer focusing. The house is on fire. And so next week, we are going to start with this question. Eh? We're going to start with this question. Yes, then we do S2 from the textbook. Yes, and then during the week, I'm going to send you questions. I think this is the strategy that I would use. I'll give you questions and then, well, just that I don't know your schedules and other. But if I can maybe if you can give me a feedback now, if I can post a question, so guys, let's do this question and I'll give you the whole day. Is it fine? Let's have suggestions.
Personally, I won't do anything between working hours.
Yeah, because you are working and all that, so obviously it's not. So let's say I post a question today, and I say by tomorrow. Is it fine? No, today I'm not going to send anything. I'm just saying during the week. So, okay, most probably expect something on Monday.
No, Monday we are submitting a portfolio exam, so
Okay,
can I suggest that we don't fiddle with Monday? And Tuesday, I think we need a break.
okay.
Maybe Wednesday, Thursday, between Wednesday and
Wednesday and Thursday. So expect anything Wednesday and Thursday. So to maybe to even make it work better, I'm going to post something on Wednesday and say, guys, can you please by Thursday, can you please submit your answers, right? And then we maybe that way it's going to help. All right. So I think let me quickly stop. We've come to the end of our class today, and then I still owe you the first question, eh? Yeah, and how to do that. I don't even need the calculator. I'll research on my own, and then I'll let you know. I'll post something if I have to even explain it in the slides and all of that. But thank you for your time. Uh, I'm still going to check. You wanted me to.
it should be something that we have done. I would suggest from risk return, risk and return, because it's also very important for the exam. Work, very important for the exam, and cost of capital too.
Yeah.
Between the three.
Yeah, another question I wanted to ask whilst I'm still here is should I just send you guys one question or I can at least two?
At least two. Maybe you don't be the first to answer. Remember we've got kids who are doing homework as well.
Yes.
It's okay, just send. And
Two questions.
send two.
Ne?
Because it
Yeah.
doesn't mean that if we have kids and the others don't have kids, the others
Then
cannot
yeah.
unfair complaints.
All right. Let me just post two.
Two and
So I'll pick a question from like what we've done here, especially on the cost of capital. Then I'll pick one from last week, risk and return. Yeah, risk and return, and then we deal with those. Just those two. I'm not going to add more. Just those two. All right. So I'm going to post them on Wednesday, and then Thursday we submit our answers, and then we look at. I'll look at your answers individually. Then, if it's possible, I'll have to engage with you guys individually so that at least we help out each other. You can email me the answers. I think it's a better approach so that
WhatsApp you.
you can WhatsApp me. Take a snapshot. WhatsApp me, and as long as I can see your.
Typing for me is not to be a hassle.
In fact, I think writing it on paper is the best approach because in the exam you are not going to type. In the exam you are going to be using your pen, and so rather write it on paper, take a snapshot.
Like privately.
Yeah, not on the group. Send it to me on the private chat, and then I'll deal because some of the answers might be wrong, so you don't want to be embarrassed in the group.
Also, we are mature.
No, it's fine. Okay, so I think we've